This is Jack Bogle, multimillionaire founder of Vanguard, one of the world's most influential financial institutions. Despite his impressive achievements, he held an extremely simple investing philosophy, which made him millions and continues to guide everyday investors today. Over the next few minutes, I'll share some of his simple rules for investment success from his book, The Clash of the Cultures. And while this video is not financial advice, these rules provide insights that could help you out on your own investment journey, regardless of the level you're at. This means whether you haven't invested a single dollar or have a multi-million-dollar portfolio, these rules apply to everyone. So let's check it out. Quickly before we dive in, keep in mind that Bogle's core belief behind investing is that it's a long-term game with no shortcuts. And you'll notice this core belief is interwoven between all of these rules presented throughout this video. With that in mind, rule number 1 is time is your friend, impulse is your enemy. There's a phenomenon in finance that Albert Einstein supposedly called the 8th wonder of the world. If you're younger in your investing career, it's even better because you have more time to benefit from this powerful force. You may have heard of it, it's called compound interest, or for the sake of stock investing, compound growth. Explained simply, compounding means that you earn money not only on your original investment, but also on any money you've already earned from it. For example, if you invest $5,000 into a fund with an average annual return of about 8%, on average, after a year, you can expect to have a value of $5,400. Now, thanks to compounding, that same 8% will be applied to your new balance of $5,400 rather than just the original $5,000. Then you can imagine this effect year after year as you contribute more and more money. This compounding effect can lead to exponential growth as your money starts to earn money on top of previous gains. Unfortunately, it's not always that simple. As you likely know, the market has ups and downs and what we'll call volatility. Said another way, this 8% return for said fund is not guaranteed every single year. To be clear, stocks don't pay interest like a bank account would, but you can experience a similar compounding effect if you invest money into a fund where stock prices rise, for example, or if you're paid out dividends, which are then reinvested. And for those who don't know, dividends are just a share in a company's earnings, which some companies will pay out to you if you're a shareholder. Getting back to Bogle's tip, the reason that time is your friend is that by investing early and often, you can take full advantage of compound growth. The second half of this tip, impulse is your enemy, suggests that you shouldn't let emotions drive your investment decisions. Short-term market fluctuations you'll see pretty much every single day may lead you to try to make these trading decisions based on impulsive decisions. For instance, you may want to limit your losses if you see a fund starting to perform negatively. To Bogle, though, he believes investing is a long-term game, and you should avoid these impulsive decisions for trading at all costs. This next tip builds on this foundational mindset about investing, and it's actually a pretty simple concept. Number 2, buy right and hold tight. Have you ever purchased stock for what you thought was a hot new company at a low price? Or maybe you started pouring money into a crypto that your friend claimed was going to the moon. Then from there, every single day you took out your phone and saw the prices going up and up until one day things came crashing down and you lost all your money. I know that I've been there personally, and it's pretty much gambling. Now, Bogle believed in doing something completely different, which is a much lower stress strategy, and has actually been proven to be successful. His strategy of buying right means that you should diversify your portfolio by investing in low-cost index funds. For those who don't know, index funds are investments that track an entire market index rather than just buying a stock or a bond. A popular example is a fund tracking the S&P 500. And this is a diversified fund which tracks performance of the 500 largest US companies. When you buy into this fund, you get a piece of each of these companies. And this gives you exposure in your portfolio to different sectors like healthcare, financial services, etc. And naturally, if you invest in a fund like this, if a certain sector like technology is booming, another area is performing poorly, those two can balance each other out and you can still see growth in your portfolio. At the time of making this video, the average annualized return for a fund tracking the S&P 500 is 10% since 1957. Again, as mentioned earlier, you should always expect market fluctuations. There's no such thing as a guaranteed return. But this is where the concept of hold tight comes into play. Hold tight means to buy and then wait. And yes, it's boring and lazy, but it works. Number 3, forget the needle, buy the haystack. Instead of trying to find the next Apple or Tesla, Bogle advised to just buy the entire market. And this can be done by buying an index fund tracking the total US stock market, or something like the S&P 500 fund, which we covered earlier. Finding a winning individual stock is like finding a needle in a haystack. It's difficult, it's risky, and it's probably not going to happen. As an investor, instead of trying to find this needle, just buy the entire haystack. There's a chance that the needle or multiple needles will be in the haystack that you invest into. In the past, in my own portfolio, I've tried to pick and choose stocks, and I've had some winners like Nvidia, but also losers like Peloton. Honestly, in most cases, I would have been better off just taking that money and putting it in an index fund like Bogle would advise. Now, wouldn't it be great to find a golden pathway to wealth, something you could invest in overnight and become a multi-millionaire? To Bogle, this was not possible. And that's why rule number 4 is have realistic expectations. As tough as it is to admit, getting rich quick from investing is unrealistic. There are rare cases, and maybe that could be you, but I personally don't think it's gonna happen to me. I just don't think it's possible. And as a long-term investor, I have this understanding in the back of my mind. On this channel, the goal is to help you unlock financial freedom, which I believe is something everybody deserves. But the best way to achieve this is by following practical and sustainable methods. In his book, The Clash of the Cultures, Bogle used an idiom, which he called the bagel and the donut, to compare two opposing investing strategies. First, there's the bagel, which is relatively healthy, somewhat good for you, and this represented long-term investing. Then on the other hand, there's a donut, which is sweet and tempting, but it is certainly unhealthy and not good for you in the long run. And this represented short-term speculation. The idea was that while short-term trading could offer quick gains, it's not sustainable or a healthy approach for an everyday investor. Now, circling back to the idea of compound growth, slow and steady wins the race when it comes to investing. This approach, which is just choosing the bagel over the donut, is much more aligned to building lasting wealth. Rule number 5, there's no escaping risk. You need to remember that there's always risk with the market and nothing's ever guaranteed. The only way your money is completely safe is if you take it and literally put it in a safe or under your mattress. Even then, you won't be earning any interest, inflation might eat at its value, or you could even misplace things. Despite investing being risky, to Bogle and many other successful investors, this isn't a reason you should avoid doing it. Bogle's book reads, yes, money in the stock market is very risky over the short term. But if your portfolio is well diversified, it should provide remarkable growth over the long term. Everyday investors follow Bogle's rules for investment success and are able to retire millionaires. They typically don't do this by trading penny stocks or options. They instead bought low-cost index funds and waited. If you made it this far in the video, consider yourself lucky because his final rule is the most important on the entire list. Number 6, stay the course. To Bogle, the ultimate secret to long-term investing success was simply sticking to a plan. It's not about picking the hottest stocks or predicting market movements. It's about staying patient with long-term, disciplined investing. Once you've smartly set up your portfolio with index funds, just keep going. Of course, the usual guidance is that as you age, start to allocate more money to a less risky asset like bonds. But other than this, keep that mindset of staying the course. In this way, you avoid making decisions based on emotions like fear or excitement, which can mess up your judgment around investing. Staying the course is an important mindset shift, and true financial freedom often relies on continuing to make sustainable and smart choices around your money. One final thought I have is that many of us, and this includes myself, we often spend too much time fixated on this end goal of life. And that's whether it's retiring with millions in your bank account, never having to work again, or being able to relax on a beach. And while I hope this type of future is possible for everybody watching this who actually wants this, I think it's more important to focus on living in the moment and enjoying the now. That said, having smart investments working for you in the background of your life can limit stress and bring you much closer to reaching this level of financial freedom. I'll leave you with a powerful quote from Bogle, who said, "My only regret about money is that I don't have more to give away." Thanks for watching.